They call it the nuclear option in the escalating economic war between the world's two biggest powerhouses. Silent financial bomb poised to detonate, not in the skies, but across global markets. This is the looming threat in the ongoing dance between the United States and China, an invisible yet immensely powerful weapon in a battle of will, strategy, and sheer economic might. And the burning question remains, who has the staying power in a trade conflict that seems destined to endure? China holds a unique card in this high-stakes game. For decades, constant in the global financial landscape has been Beijing's position as one of the largest creditors to the United States. Simply put, they hold a massive amount of U.S. debt, denominated in dollars. We're talking about hundreds of billions. That's why economists refer to it as the nuclear option. Every time tensions flare between these two superpowers, the same nightmare resurfaces. What if China decides to unload all those U.S. Treasury bonds? Would it send global markets into a tailspin? Who would step in to fill the void? In this video, we'll break down why China accumulated so much American debt in the first place, and what the real-world consequences would be if they actually decided to sell it off. Or perhaps more subtly, simply stop reinvesting. But before we dive into the potential fallout, let's cover the basics. What exactly is U.S. debt? When we talk about the public debt of the United States, or any country for that matter, we're referring to the securities issued by the Treasury Department to finance government spending. There are three main categories: Treasury bills, Treasury notes, and Treasury bonds. Collectively, these are known as U.S. Treasuries, and they form the backbone of U.S. public finance. Today, the total U.S. federal debt has ballooned to well over $37 trillion, and China holds a significant, though fluctuating, portion of this. The rest is spread among Japan, pension funds, central banks worldwide, and private investors. But why buy U.S. Treasuries in the first place? The answer for a long time was simple: safety and liquidity. The United States has historically run a significant trade deficit with China, buying far more goods from Beijing than it sells. This imbalance has been a fundamental characteristic of global trade for years. China exports, America imports. Normally, when a country imports more than it exports, its currency should weaken, making its exports more competitive and rebalancing the trade books. But the U.S. has managed to maintain a structural deficit for decades. How one key factor has been China's role as a major buyer of U.S. debt? For years, this was a mutually beneficial, albeit precarious, arrangement. As China's economy boomed in the early 2000s, becoming the world's manufacturing hub, a flood of foreign investment poured in. Factories multiplied, and exports soared. More exports meant more U.S. dollars flowing into China to keep its own currency, the yuan, relatively undervalued, and its exports competitive. The People's Bank of China would print yuan and use it to buy U.S. dollars in the open market. These massive dollar reserves then needed a safe and liquid place to be stored and earn a return, leading them directly to U.S. Treasury bonds. These U.S. Treasuries are the reserve currency of the world, easily bought and sold even during times of crisis, offering stable interest payments and a high degree of repayment security. This, in turn, helped to keep the U.S. dollar strong, which benefited China by supporting American demand for Chinese goods. It was a codependent relationship, often referred to as chimerica, where the U.S. became increasingly reliant on Chinese manufacturing, and China became a major holder of U.S. debt. Back in 2000, China held a relatively small amount of U.S. Treasuries compared to Japan. The balance shifted dramatically around 2008, and China's holdings peaked in 2013. Since then, China has been gradually reducing its exposure to U.S. debt. While still a significant holder, its position has evolved as its own economic priorities have shifted. One major factor driving this shift is China's ambitious Belt and Road Initiative, a monumental project aimed at reshaping global trade routes by connecting Asia, Europe, and Africa through massive infrastructure investments. Financing this requires significant capital, and some of that is being generated through the strategic selling of U.S. Treasury holdings. Furthermore, the rise of the BRICS economic bloc, Brazil, Russia, India, China, and South Africa, and their collective desire to reduce dependence on the U.S. dollar and establish an alternative financial system is also playing a role. Holding fewer U.S. treasuries aligns with this goal of greater financial independence. And then there's gold. China has been steadily increasing its gold reserves, a diversification strategy, and a hedge against geopolitical instability. As gold isn't subject to sanctions in the same way that U.S. bonds are, now with the ongoing and at times escalating trade tensions, including the latest rounds of U.S. tariffs on various Chinese goods, the inevitable question arises. Could Beijing retaliate by targeting the other side of the U.S.-China financial link, the debt? Could they trigger a market shock by selling off their treasury holdings en masse? Or more subtly, by simply ceasing to reinvest as their bonds mature? While predicting the future is impossible, we can engage in a logical exercise to understand the potential consequences, how markets might react, and what the U.S. Federal Reserve might do. The immediate consequence of a significant Chinese sell-off of U.S. treasuries would likely be an increase in treasury yields. Remember, in the bond market, prices and yields move in opposite directions. Less demand means lower prices, and therefore higher yields. Higher yields translate to more expensive borrowing costs for the U.S. government, potentially impacting everything from infrastructure projects to social programs. The U.S. dollar itself could also face downward pressure. If China reduces its dollar reserves by selling bonds, the value of the dollar on international currency markets could weaken. While a weaker dollar could make US exports more competitive, it would also increase the cost of importing goods, exacerbating the inflationary pressures already fueled by tariffs. Furthermore, a large-scale Chinese sell-off could spook global markets. U.S. treasuries are traditionally seen as the ultimate safe haven asset. If the perception that they are no longer a stable store of value takes hold, it could trigger broader financial instability and market volatility. However, it's crucial to remember the sheer size and liquidity of the U.S. Treasury market. Trillions of dollars worth of U.S. debt are traded daily. While China's holdings are significant, the market is vast, and other investors might step in to take advantage of higher yields. In a worst-case scenario, the U.S. Federal Reserve might be forced to intervene with some form of yield curve control, essentially buying up the treasuries that others are selling to prevent interest rates from spiraling out of control. But to do this, the Fed would likely have to print more dollars, potentially leading to currency devaluation and inflation over the long term. This is the delicate balancing act central banks face in times of financial stress. It's also crucial to consider the potential consequences for China. Selling off dollar-denominated assets would likely cause the value of the yuan to appreciate, making Chinese exports more expensive and less competitive globally, a self-inflicted wound. Moreover, it's not entirely clear where China could park hundreds of billions of dollars with the same level of security and liquidity that the U.S. Treasury market offers. Perhaps the biggest risk for China in a massive sell-off scenario is the potential for triggering a global financial crisis. While China's roughly 2% share of the total treasury market might seem small in normal times, a large coordinated sale could be the catalyst that triggers a broader panic, hurting not just the US, but the entire global economy, including China itself. This is likely why Beijing has historically been cautious about wielding this nuclear option. However, there is a less dramatic, but still effective alternative: simply allowing US treasuries to mature without reinvesting the proceeds. Data suggests that a significant portion of foreign-held U.S. debt is in shorter-term maturities. China could steadily reduce its exposure over time by not rolling over these bonds as they come due, a silent, strategic withdrawal without triggering immediate panic. This process appears to be already underway, with China gradually reducing its treasury holdings in recent years, while increasing its gold reserves and exploring other currency alternatives. Ultimately, Beijing's long-term goal isn't just a tactical response to US tariffs. It's a strategic plan to diversify its foreign currency reserves, reduce its dependence on the US dollar, and potentially shift towards other currencies in global trade. This approach makes even more sense today as the interest rate differentials between the US, Europe, and Japan have narrowed, making alternatives to the dollar more attractive from a yield perspective. This ongoing financial and geopolitical chess match deserves close attention. In a world where headlines often scream about immediate crises, the subtle shifts in global financial power could have the most profound long-term impact. The next move in this high-stakes game could be the one no one anticipates. Thanks for tuning in to Money Made Easy. Share your thoughts on this evolving US-China financial dynamic in the comments below. Are we on the cusp of a major shift in global monetary power? Let's discuss. Don't forget to subscribe for more accessible insights into the world of finance. Happy investing.